Let's talk about the Chapter 3 exercises. These are the computational exercises that I have open right here. They're really just from the back of your chapter, so I just have the ebook open to Chapter 3, and I'm at the computational exercises portion of them. I'm going to go through most of them for Chapter 3 with you. You can see here the first one, 22. Goose Corp, a C Corp, incurs a net capital loss of 12 for 18. Has ordinary income of 10 in 18. They had net gains of 2,514 and 5,017. So part A, determine if any, determine the amount, if any, if I say that right, with a net capital loss of 12,000 deductible in 18. So remember, this chapter is about C Corps, and we know there's several differences between a C Corp and individual tax returns. So treatment of capital losses is one of those. So the answer is 0 for letter A. The amount, if any, that can be deductible in 18. The amount is none. If this was an individual, the answer would be yes. I could do some. Up to $3,000 can be offset against ordinary income per year, and then that can be carried forward every year until used up. So the answer is A. A corporation, or is none, because the corporation cannot offset ordinary income against capital losses. For B, determine the amount, if any, of the net capital loss that is carried forward to 19. So remember the rule with corporations, they can go back 3, and they can also go forward for 5. So they can go back 3 and forward for 5. So first they'll go backwards and look backwards. And we can see here that in 14 they had a gain. That's too long ago. This is 17. So that's too long. So that one doesn't count. But 17, yes, I can do that. So 14 too long ago, 17 is a yes. So what I would do then is essentially refile my 17 return, offsetting that $5,000 gain, and then getting, money back or a tax credit for that. Then what's left over I would carry forward. So 12 minus 5 we all know is 7. So the answer to B is 7,000. Question 23 is Aquacorp. They buy non-residential property on May 8 for $1 million. Straight line cost recovery is taken in the amount of $89,765 before the property is sold on November 30 of 18 for $1.5 million. So what they mean by cost recovery is depreciation. So that's just tax speak for depreciation. Question A, compute the amount of Aqua's recognized gain on the sale of the realty. And then B is, we'll talk a little bit about 1231 and 1250, which comes from your chapter. So it's called depreciation recapture. And there's a little section in the chapter about that. So I'm going to do this one in Excel. And so remember that we have money, cash of $1.5 million. And we subtract from that this item here. We're going to take $1 million. Remember, that was our basis. And then the depreciation was 8,9,765. And I'm going to just basically take that $1 million and subtract it from that. Okay, so take the million minus the 8,9,765. We get 910,235. And so my capital gain is the difference between the $1.5 million cash received and the 910,235. Okay, 589,765, and I should format this. Okay, so everybody sees that, 589,765. So that was my answer to part A. Part B, determine the amount of the recognized gain treated as section 1231 gain and the amount treated as 1250, or what they call the recapture or ordinary income. So then I basically have to split the gain between recognized gain and then depreciation recapture, which is ordinary income. So the recapture is right here. Let me get to that. So the recapture is this amount here, is So this is the section 1250. So SS means section, and this is section 1250. And what I'll do is take the 89,765, the depreciation, and I multiply that by 20%. And I get 17,953. So my recapture is 17,953. And then everything else is this the regular gain under, so what I can do then is I take the regular gain of 589,765. I back off the section 1250, 17,953, and I get the other part of it, the recognized gain of 571,812. So recognized gain and the section 1250 recapture. Okay, question 24. With this one, it's in the current year, Nighthawk Corp, a calendar year corp, 3.7 million of adjustable income, 125 of business interest income, 0 floor plan financing interest, and 1.4 million of business interest expense. Part A, assume Nighthawk has average gross receipts of the prior 3-year period of 33. Determine the Nighthawk's current year deduction for business interest. So there's a couple pages in the chapter that deal with this topic of deductible business interest. And there's 2 rules. And for Part B, it says 23 million, so that's kind of the cutoff is that right there. So there's a limitation, business side, and it's $25 million or less. So obviously in Part A, we're above 25 million, so that affects the computation. I'll do this one over here. And so the limit is this. You're allowed 125,000. Okay, so right off the bat we get 125. And then it's 30% of adjusted taxable income. So let's go back to the question. Adjusted taxable income for them is the 3.7 million. Okay, so I'll take 3.7 million. Multiply that by 30%. And we get 1,110,000. So my answer is the sum of the 125 that I get plus the 1,110,000. Okay, so 125 plus 1,110,000, and 1235 is my answer. 1,235,000. Part B now I'm under the $25 million threshold. For Part B, right here, 23 million, and then the answer is the full 1.4 million. Okay, so the 1.4 million full amount of business interest expense can be recognized or deducted. Under Part A, it was close to that. It was 1235. Okay, so just FYI, just that one rule mattered in how we approached both of the answers. So question 25 is Hummingbird Corp. Closely held C Corp, not a PSC, and a PSC is a Personal Services Corporation. The chapter has a page where it explains what those are, but think mostly service companies, doctors, lawyers, accounting firms, and so on. But this one is not a PSC. It has 40,000 of net active income, 15,000 portfolio income, and 45,000 loss from a passive activity. Compute their taxable income. And so there's a section in the chapter that deals with passive activity losses. And that's what this question is trying to get us to. So a passive investment is something that you invest in that you're not actively involved in. So closely held C Corp, not a PSC. What they can do is they can offset passive activity losses against net active income, but not against portfolio income. Okay, so let me just explain that again. They can offset passive activity losses against net active income, but not portfolio income. Okay, so just FYI. So the calculation then, the question is, what is their taxable income? Okay, and we'll just do this one down here. So their taxable income for the year is the 40,000 plus 15,000 minus 40,000. So the sum of those, and pretty easy to do the mental math, it's 15,000. So 40 plus 15 minus 40 Okay, so the 40 plus 15 and then minus 40, and because they're only allowed to deduct 40,000 of the passive loss because they have 40,000 net income. So they can't use that extra 5,000 for anything else. So the answer is 40 plus 15 minus 40. So I can only deduct it against the active income, not the portfolio. So there's 5,000 of loss that I don't get to deduct. I'll take 40,000 of it against this 40,000 here. So 15 is what's left over. Okay, question 26. Compute the charitable contribution deduction for each of the following C Corps. So there's a few rules in the chapter that deal with this, and essentially it's kind of a three-step process that we go through, and it depends on what kind of property it is that's being donated to. So that's a part of what comes into the equation. So that matters. So for letter A, Amber Corp donates inventory of clothing, so it's maybe a merchant or maybe a clothing manufacturer, but they have inventory of clothes that they want to donate. Their basis is 24,000, so essentially their cost to make it or a cost of acquiring it, and the fair market value is 30 to a qualified charitable organization that operates homeless shelters. Okay, so let's go through that one. So basis of 24, fair market value of 30. So let me just format a big area of my document here. So let's go ahead and drop that one in. So what they can do is they're allowed to do two different things. So one of them is the sum of the basis plus 50% of appreciation. Okay, so that's one thing they're allowed to do. And so let me just do this as just a one like that. Or they can do this. They can do the basis doubled. Okay, and you take the lesser of. Okay, so here's the situation that they're looking at. The lesser of the sum of the basis times 50% of appreciation, or the basis times 2. Okay, so the basis was 24,000. Okay, we can double the basis and get 48,000. We all know that. Remember that the value was 30. The fair market value is 30. So I'm going to take 30,000 minus 24,000. Okay, we all know that's 6,000. I can take half that. Okay, so I'm just going to change my formula here to 30 minus 24 times 0.5. I get 3,000. So the sum of the two is 27, lower than 48. So 27,000, which is lower than 48. So the winner, the answer is 27. So that's letter A. Letter B, Brass Corp donates stock held as an investment to Western College, a qualified organization. So in other words, they're a nonprofit. Brass acquired a stock 3 years ago for 18. Fair market value is 32. Western College plans on selling the stock. So the question is, what is the amount of the donation? The answer is, you can maybe think this through, it's just simply 32,000. Because this is stock, and basically because it's a capital gain property. So deduction is the property's fair market value. Okay, so a stock is a capital gain property. Therefore, the deduction is for the property's fair market value. Now, I will tell you that what they plan to do with it is irrelevant. So they told us they plan to sell it. Well, clearly, if we give them the stock, we don't really control it anymore. We can't make them sell it. Maybe we put that in the agreement, but essentially it's now theirs. That the fact they sell it's great, but they don't have to. What they plan to do with it is really up to them. It doesn't matter. It's because this is capital gain property that we can do the fair market value. And remember, if it's a stock, we know exactly what the fair market value is. The stock trades every day, so that's an easy one. The last one, C, Ruby Corp donates a sculpture held as an investment worth $130,000 to a local museum, a nonprofit, a qualified organization, which exhibits the sculpture. Ruby acquired the sculpture 4 years ago for $55,000. So the question then is, what's the amount of depreciation? What's the amount of the charitable contribution deduction that they can take? So the answer is the full amount, $130,000. Again, this is a capital gain property. Okay, just like the stock, this is a capital gain property. So again, we can use fair market value. Also, what helps with this deduction, stock is an intangible property, going back to letter B. But for letter C, this is a statute. It's a tangible personal property put to use in a related qualified organization's exempt function. So that helps the case also. Okay, the fact that we're giving it to a museum who obviously displays art, statues, and so on. So fair market value would be the deduction. Okay, the next one is 27, and this deals with Crane and Loon, two unrelated C corps, had the following transactions, so income, expenses, and then dividends received. And it says compute the dividends received deduction for Crane and then for Loon. And there's a couple of pages in the chapter that deal with what we call the DRD, dividends received deduction. And essentially, what happens is if you're a corporation and you own stock of another corporation, when you receive dividends, you're allowed to deduct a certain amount of those dividends from taxable income. And the amount that you are allowed to deduct depends totally on how much of that stock do you own. So 19% or under is 15%. And they told us this was 15. So there's a couple of pages in the chapter. The PowerPoint explains it also. Okay. So with that in mind, looking at 27. Now, the big rule here is there a loss? So take a look here, and we go gross income is 180. Expenses are 255. So right away there's a loss, right? As you can see, there's a $75,000 loss when we do that. And then we have the dividends received of 100,000, and obviously half of that is 50,000. 50% of that's 50,000. So we can all do the math on that. So there's what they call a net operating loss rule when it comes to the dividends received deduction. And so we are going to be allowed to deduct 50,000, okay, half of that, because they already have a loss. So we're going to take $50,000 loss. I'm sorry, $50,000 deduction on those dividends. Letter B, for Loon Company, take a look here. So income 300, expenses are 310. So again, they're at a loss. This will be what they call the taxable income limitation. Okay, taxable income limitation. So we compare 50% of this, the 230, which we all know is 115. But I'm going to run into another scenario here with them. So what I do is this. I'm going to do this one in Excel. It'll be a little bit easier to see it. So we're going to take their income of 300. Okay. And then we add what the dividends received would be. Okay. And then we come and subtract their expenses. Okay. Oops. And let's go, oops, I'd make it smaller. Let me just add that up. Okay. That's 220,000. I can take half of that. Is essentially what we can do. 50% times this. So we all know half of this is 0.5. Okay. So 110,000. That's my deduction for this particular scenario. With the other one, let me type in the numbers from Part A from Crane, the first company. And for Crane, it was 180 of revenues. Income from dividends was 100. Okay, and then we had expenses of 255. Okay, so right off the bat, I have a loss. Okay, so I have a 25,000. Actually, it's a gain, 25,000. But then when I apply 50% of the dividends, okay, times 0.5, okay, now that's a deduction, so I'm going to end up at a loss, a $25,000 loss. So I basically take that, oops, the 25 minus the 50, if I can do my math right, and end up at a loss, 25,000. So I can take I can take half of it here, okay. Over here, I'm capped at the 110. That's the most I can take, is the 110. So a few subtleties with the rule, and that's what they explain very well in the chapter. So just make sure you take a look at that before you dive too deep into the homework. And then the last question for chapter 3 that we'll cover is 28. Cherry Corp is a calendar year corp. C Corp formed and begins business on April 1. In connection with the formation, they have some organizational expenditures of $54,000. So the question is, what is their deduction for organizational expenditures for the year? And there's some rules around that, again, explained in the chapter very well. And generally, the rule is that $5,000 can be expensed, and the remaining is offset or amortized over 180 months. Okay, but that $5,000 is reduced dollar for dollar for anything in excess of $50,000. So you can see they incurred $54,000. So there's that dollar for dollar reduction. So basically, they have the $5,000. Okay, whoops, I went too many zeros there. And I have to then subtract from that $54,000 minus the $50,000 limit. Okay, so dollar for dollar, I have an exclusion. So I have to take my $5,000 minus the $4,000 over 50 that I am, and I can take $1,000. Okay, so that's what I can take right away as $1,000, and then I amortize the rest. And so I have, remember that I have 54,000 in total. Okay, so what I do is I take 54,000 minus the 1,000 that I just took, so that's 53. If I can type my numbers in correctly. Okay, so I'm at 53,000. And then I divide that by 180 months. Okay, and so I'm just going to do that here. So I can take the 53,000 left over, divide by 180 months, and I get that much per month. Now, in the problem, this company started on April 1. So January, February, March are gone. So 3 months have passed. April to December is 9 months left over. So I'm going to multiply that by 9 months. And so my answer is 294.44 times 9. I get 2,650 plus the 1,000. So my answer is the sum of the 1,000 that I get plus the amortization. So the answer is 3,650. Okay, and you'll have a few problems like that when you do the homework. All right, so that is the homework for Chapter 3. As always, if you have questions, just let me know. Hopefully that will help you get going on those things.